Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at HIMS and HERS Health.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of HIMS and HERS Health. When we look at this name, the core investment thesis has really fundamentally shifted.
How so?
Well, this isn't just a high-growth stock anymore. I mean, it is, but it's now an aggressively scaling company that's also proving it can be profitable. That's the new story.
And when you look at the recent numbers, that shift is, well, it's undeniable. They're putting up metrics that are turning heads, even if the growth rate itself is showing, some signs of maturing.
Exactly.
Let's look at Q3 2025 revenue. It came in at what, $599 million?
$599 million, which is a 49% year-over-year expansion. In the digital health space, that is still flying.
Oh, for sure.
But that 49% rate, while robust, you do have to look at the quarter right before for some context.
The Q2 numbers.
Right. Q2 2025 revenue was $544.8 million. That was an incredible 73% year-over-year spike.
So deceleration from 73 down to 49.
Yeah, and that's a natural normalization, as the company gets bigger, but the market is rewarding them not just for revenue, but for the bottom line now.
And this is where it gets really compelling. It addresses that primary concern investors always had about these high-growth tech names. Are they actually scaling profitably?
And the answer is a resounding yes. In Q3, they achieved net income of nearly $16 million.
$15 million in net income. And the adjusted EBITDA.
That exceeded $78 million.
Wow.
Yeah, that $78 million in adjusted EBITDA is the key number here. For anyone newer to this, EBITDA is basically earnings before interest, taxes, depreciation, and amortization. It's a clean proxy for a core operating cash flow.
And the fact that their operating margin is getting wider suggests that operational leverage is really taking hold, right?
That's it, exactly. It means every new dollar of revenue costs them less to acquire and service than the one before it. That's the magic of scaling.
So if we look forward, management seems really confident. They maintained a strong full-year 2025 revenue outlook,
right,
guiding for something like $2.3 billion.
Between $2.335 and $2.355 billion. But more critically, the street is pricing in a massive acceleration in earnings.
Right.
Analysts are projecting 2025 earnings per share EPS to improve by a phenomenal 77.8% over 2024.
77.8%. I mean, to put that in perspective, that's not just leading the sector. That is way, way higher than the average projection for the entire NASDAQ Q composite this year.
Absolutely. That kind of earnings acceleration is a huge constructive signal that margin expansion is the dominant story right now.
And that strong performance leads us right into their capital allocation strategy, which is maybe the clearest signal management can send.
You're talking about the buyback.
The huge buyback. They just authorized a brand new $250 million share repurchase program set to run through 2028.
And this came right after they finished a previous $100 million buyback. So that's $350 million total they've committed to returning to shareholders. It's essentially management saying, we think our stock is cheap.
It's the highest form of insider conviction. They're using their own cash flow to buy back their stock because they fundamentally believe the shares are undervalued based on where they see future profitability going.
Okay, wait, hold on. You're praising the buyback as a sign of confidence. I get that. But at the same time, they just raised a massive $870 million through convertible notes. If they have all this cash flow and think the stock is so cheap, why are they raising debt? Isn't that a bit of a red flag?
That's a great question, and it highlights a really smart strategic trade-off they're making. They are using that debt, the convertible notes, to finance future growth initiatives.
The capital-intensive ones.
Exactly. Things like AI integration and diagnostics expansion. And convertible notes are basically hybrid bonds that can be converted into equity later if the stock price hits a certain higher price.
So they're making a highly confident long-term bet on their own stock price going up. Precisely. They're saying, we think our growth will be so high that converting these notes at a higher price later will be way less dilutive than selling new shares today at what we think is a low valuation. It's smart capital discipline.
Okay, that makes sense. Speaking of their strategic foundation, the platform itself is really their core advantage, right? The moat we always talk about.
Absolutely. It's not just a shop. The company operates this highly durable, subscription-led care platform. And that's what creates the moat. The numbers back it up, too. They have a subscriber base of approximately 2.5 million users.
And that base is still expanding rapidly, growing about 21% year over year.
Yeah.
But what actually makes it sticky? I mean, why can't a competitor just launch a similar service and undercut them on price?
Think about it from a patient's perspective. Once your mental health treatment, your dermatology consultation, your sexual health routine, and now your weight management plan are all integrated through one digital hub.
It's a huge hassle to switch.
It's a huge hassle. The stickiness comes from very high switching costs. You've established treatment relationships. You've got your digital health records there, your personalized care plans. You're not just going to jump ship for a few bucks.
And they've also expanded into these high-demand services.
Mhm.
The weight management category with the GLP-1s, those are the new, incredibly effective anti-obesity drugs. That has to be huge for them.
It just deepens the engagement. It increases the lifetime value of each subscriber and helps keep that average revenue per user or ARPU high. It's an integrated ecosystem that's really hard for a competitor who only focuses on one thing to replicate.
Okay, so that's the compelling bull story.
Mhm.
But we have to talk about the volatility we've seen recently.
Yeah.
This stock hasn't moved just on its fundamentals. There's a significant bear case built around one major overhang.
That's right. The most material risk on the table right now is the securities fraud class action lawsuit.
Right.
This lawsuit alleges that the company made materially false or misleading statements, and it's all about what the plaintiffs are calling illegitimate promotions related to
Wegovy.
Wegovy, the popular anti-obesity drug.
Let's unpack that a bit. Illegitimate promotions sounds vague, but it obviously carries a lot of weight. What's the lawsuit actually claiming?
Well, the claim centers on the company's communication around their ability to provide access to these high-demand weight loss drugs. The plaintiffs allege the statements were misleading about how sustainable or even legal those promotions were.
So the risk here isn't just financial, it's reputational damage.
Exactly. And regulatory scrutiny. The market gets nervous if it thinks a company was inflating its future capabilities.
So what are the potential financial consequences here? I mean, are we talking about something that could kill the balance sheet?
Well, a death blow is unlikely, but potential outcomes include substantial settlement costs. Based on similar cases in the sector, we could be looking at a range of, say, $50 million to over $100 million.
That's a real hit.
It is. And you have to factor in the reputational damage that could slow down subscriber growth for a little while. That said, the company's strong, ongoing profitability, with that $78 million plus in quarterly EBITDA, provides a really significant financial cushion. It's manageable.
And that brings us right back to the buyback, doesn't it? If management really thought this lawsuit was catastrophic, they probably wouldn't be dedicating $250 million to buy back shares right now.
That's the core mitigation argument. It suggests they view the risk as either manageable or that it's already been priced into the stock.
Okay. What other risks are there?
The other key risk is that growth deceleration we mentioned earlier. The market is now pricing in a 2026 sales growth rate of 17.6%. That's still growth, but it's a big slowdown from the 49% and 73% peaks.
And a slowdown like that usually causes a growth stock to lose its premium valuation. So what's the counterargument for investors?
The counterargument lies entirely in the margin expectations. The projection for 2026 earnings per share growth is 22.3%.
So EPS growth is outpacing revenue growth.
By nearly 5 percentage points. This signals a healthy, maturing business. They're transitioning from prioritizing growth at all costs to prioritizing operating efficiency and margin expansion. For a long-term investment, that's a very constructive trade-off.
All right, let's switch gears to the technical picture and institutional flows. Despite the lawsuit and market jitters, the stock has shown some serious strength this year overall.
It really has. HIMS and HERS has delivered impressive 44.9% year-to-date gains in 2025. That's significantly outperforming the broader healthcare IT sector and the market indices.
And some of the quantitative signals are fascinating. We're seeing one technical analysis report extremely constructive sentiment and identifying an exceptional 112.6 to 1 risk-reward setup. That is a truly wild ratio.
It is, and let's break down what a 112 to 1 risk-reward ratio means for you, the investor. It indicates that from a purely technical standpoint, the potential upside is seen as 112 times greater than the potential downside risk based on technical price targets.
It suggests the stock is extremely oversold relative to its intrinsic value.
Exactly, and we are seeing some sophisticated managers starting to pile in, suggesting they agree the technical reward outweighs the fundamental risk.
Right, from the 13F filings.
The filings show some heavy conviction. Specifically, Title Investments added over 2.7 million shares. That's almost an 1,800% increase in their position. They are betting big.
And even more telling, I think, is the accumulation from quant funds. Renaissance Technologies, a highly sophisticated manager known for their algorithms, added over 2.2 million shares.
Increasing their position by over 32% in Q3. When that kind of smart money that models risk relentlessly accumulates shares during a period of litigation uncertainty, it signals they view the risk as temporary and the opportunity as structural.
It definitely suggests confidence. Looking at analyst price targets, there's a really wide range, which reflects this whole debate. The median target is what, $48?
$48. But then you have the aggressive bulls. BTI'd, for instance, set a massive high target of $85.
Which implies over 120% upside from recent levels.
And technical analysts are viewing the recent 6% pullback as a potential accumulation phase, an opportunity to get in before the next catalyst.
So what are those upcoming catalysts? What key events should investors be watching over the next few months?
The catalyst calendar is pretty clear. The first big date is the Q4 2025 earnings release, which is expected late January 2026.
And that earnings call is going to be critical.
Absolutely. It's not just about validating their full-year guidance. More importantly, management will provide their 2026 guidance. The market will be scrutinizing two things. Sustained subscriber growth. It needs to hold that 20% plus level and proof of continued expansion in ARPU.
And beyond the financials, we need to see proof points for that strategic capital they raised, the $870 million.
We need to see tangible evidence of those AI and diagnostics product launches, which should materialize in the first or second quarter of 2026. Those launches are key to validating that debt raise.
So if we look at the whole picture, HIMS and HERS presents a truly asymmetric opportunity right now. You have a phenomenal growth and margin story. Management is betting on themselves with huge buybacks.
But that litigation risk remains a palpable threat. It creates a high-stakes trade-off. You have to be prepared for the volatility from that lawsuit and the moderating growth rate.
The reward, though, is owning an increasingly profitable telehealth platform that's really achieving sustainable unit economics. It seems compelling for investors with a slightly higher risk tolerance.
I think that's the right take.
We hope this analysis was helpful. Make sure to subscribe, like, and comment below so you don't miss our next stock analysis.